In a low-rate world, it is still possible to find income. I'm Jack Otter, editor of BARRON'S.com. I'm here with John Osterweis, co-portfolio manager of the Osterweis Strategic Investment Fund. Thanks for being with us, John.
My pleasure.
So let's start with your big picture view. You, among other things, help run a fund that has the flexibility to own either stocks or bonds. Where are you right now and why?
Right now, we're at about 50-50. I would say our net neutral position is more 60-40.
The classic allocation.
Classic. So we're a little below where we would be if we were neutral. We've had the view that the economy is expanding, but at a very slow pace, obviously with very little inflation except in certain high-end goods. We think there's some headwinds right now, particularly FX.
It's currency.
Currency, which is hurting a lot of big multinational and export-oriented companies. The big question is profit margins, which have been very high, and the question is, can they stay high? We think they will tend to stay high, but there's a considerable risk. And we're in a market that has been somewhat bifurcated in the big growth names have done extremely well. The more value-like names have been doing less well.
Yeah, it's unusual, the divergence between the two.
It's been very unusual.
Do you expect a reversion to the mean?
At some point, there always will be, yeah.
So let's go to your picks. We'll start with the best known of them, General Electric. That's really been dead money for a long time, but recently, of course, has surged quite nicely.
Yes. Well, GE is a classic, great blue chip company. Started out as an industrial company and then added a huge financial component to it.
Which worked well until it didn't.
Worked well until it didn't. And now they're getting out of the financials and reverting back to a pure industrial with extremely well run and extremely good cash flows and persistent revenues. And we think as the company gets cleaned up and reasserts itself as a pure industrial, it's the kind of stock that people will gravitate towards, and it's what I call a must-own. If it's working, every big cap manager must own it, and so we think it's got a long-term, pretty rosy future at this point.
All the headwinds that you mentioned, the strong dollar, the slow global growth, that all works against GE. So presumably, if those things resolve themselves, we could really see a pop.
Exactly.
Let's move on. You've got an interesting REIT, real estate investment trust, with an eclectic group of holdings.
Yeah, it's a company called EPR Properties. It's trading at about a 6.7% yield. The reason the yield is so high is that the properties are somewhat unconventional. Movie theaters, amusement parks, and charter schools. But what people don't understand is these are all very good assets. Their credit history is quite good, and the company grows. So we think this yield will continue to grow over time. It'll be a very interesting investment.
A 6.7% yield plus growth is pretty hard to find in this market.
Correct.
And finally, MLPs, which have been under a lot of pressure with the falling price of oil. You make the case that in the case of the toll takers, really you shouldn't worry quite so much about the commodity. Is that right?
I think that's right. I think
we should say these are master limited partnerships, which own pipelines and other energy infrastructure.
And energy storage facilities, which really are more volume driven than price driven. And as long as you can focus on ones that have very little price exposure, they should be able to grow even in a low priced energy environment. And so one we like a lot is Magellan Midstream. It's trading at about a 4.5% yield, and we think has a number of years of growth ahead of it.
Thanks very much, John.
You're very welcome.